Hello, everyone. Welcome back to Zer0es TV. I'm joined today by Gordon Johnson, CEO and founder of GLJ Research. Gordon, thank you so much for being here today.
Hey, thanks for having me.
All right. Well, this is going to be a bit of a macro flash update for our audience here. We're always focused on individual companies, but sometimes the macro becomes almost as important as the fundamentals, and it really becomes the driver of the market. So that's why we have you here today. Let's start out in China. What are you focused on there?
Yeah, so I think that in general, there's a big misconception about what's going on in China. And let's just take a step back, right? We all know, we all read, we've all heard since 2015 about the ghost cities in China, right? The literally complete cities the size of San Francisco, even bigger, with empty apartment complexes, et cetera, right? Back in 2015 and 16, guys like me and some other guys out there, Kyle Bass, Michael Pettis, et cetera, Logan Wright, one of the best out there, were very bearish. And we thought that there was going to be a collapse. Z had just come in. He had implemented and he was pursuing policy to really crack down on the aggressive speculation in the Chinese real estate market. And we thought we had reached the promised land with respect to shorting the commodity guys. We were dead wrong, right? So Z, we didn't know, had in his plan of plans to become president for life. And to do that, he effectively initially cracked down, economy slowed. He said, you know what, I'm opening up the floodgates, implemented a ton of stimulus, and commodities went to the roof. Here's the problem in a nutshell. Let's make it very easy. Property in China has gotten far too expensive. You look at price to income ratios in Beijing, Shanghai, and Guangzhou, and you're talking about a price of property to income ratio in those cities of 40 times. In London, that number is 22 times, and I'm looking at my notes here. In New York, that number is roughly 12 times. By the way, the Urban Reform Institute defined too expensive as 3 times. So what's happened? Effectively, in China, a lot of the constituents can no longer afford not just housing, but rent. They just can't afford to buy houses. So Z is having to come in and force down the price of housing. And the way he's doing that is by basically clamping down on broad-based speculation. Here's the problem. 78% of the wealth of the Chinese is tied up in housing. That number in the U.S. is roughly 35%. 28% of China's GDP comes from construction, and construction of real estate, et cetera, in China accounts for 20% of the world's steel consumption and copper consumption, and roughly 9% of the world's aluminum construction. So what's happening, right? So again, too expensive. People just can't afford housing in China anymore. Z has to do something.
Well, I want to ask you though, because this really is the dilemma that he's in, which is the growth of the Chinese economy is driven by this sector, and at the same time, the people can't afford housing. And if you want to be president for life, you need the mandate of the people. But as well, part of that mandate has clearly been driven by the growth, the tremendous growth in the economy and the improvement in standard of living that has been driven by that growth. So that is the lever that he's dealing with here. One, the growth, and the other side, just affordability of life for everyday people. When you think about which one's important and how he's going to delicately be balancing those, where does he land in terms of which one is most important?
Well, I mean, it seems clear, right? So we had China credit growth that came out today. It was down roughly 16% in September year over year. You have the China property sector, where if you look at the bonds, where the bonds are trading at for the top 10 property developers in China, they're either in default or severely distressed. You look at Evergrande, which is effectively, I think now defaulted, I think a total of 5 times on their debt. Z is not coming in to save these guys. Yesterday, China drained, I think, $90 billion CNY from the market. They're not doing what they've done historically. And I think the reason is because what they've done historically is every time there's been a hiccup and or a massive problem in China's economy, they've used the housing sector, i.e. construction, to drive GDP. The reason they're not doing that now is because if they continue to go down that path, Z is going to have a much bigger problem in the future. Keep in mind, Z is president for life. Historically, the presidents in China focused on one cycle, their presidential cycle. After that, they were gone and done. Z has multiple cycles. He's president until he's dead. So if you continue to pump this property bubble, you continue to make housing affordability out of the reach of more and more people, there's going to be uprising. So I think he's playing the long game, if you will, and he's looking at this issue and looking to basically solve this issue right now. And again, you can see it in the fact that credit growth in China is trending negative year over year. It's been negative for the past, I think, roughly 4 months. Came out again today, was negative again. You know, if they were looking to do an about face and go in and really, drive construction demand, you'd see that credit growth growing year over year, not declining as it did today. You look at what's happening with Evergrande and the other 10 big property developers in China. Z is not coming in to rescue them. So, you look at some of these statistics. Evergrande has 11% of their liabilities in customer deposits. But the problem is, again, Z's not coming in to save that. So what's happened? People have stopped buying. In the October 1st to October 8th period, property sales in China were down 45% year over year. You just don't see those type of statistics. So not only are you seeing it in the credit growth, not only are you seeing it in things like property starts, land area sales, where property developers in the first 12 days of September, their purchase of land from local governments was down 90%. You're also seeing it in the actual sale of property, right? So I think that the issue is Z is really trying to solve this problem. And I think another dynamic that's coming into play here is the energy crisis, right? And let me explain this a little bit, right? So we think effectively the energy crisis that has overcome China was a miscalculation on Z's part. I think he was trying to instill fear in coal producers and other large producers to cut production. And as a result of that, he was looking to bring down, aluminum output and steel output. But as a result of the reduction in coal output, you had a basically lack of coal, which you need to make energy. So I think it was a miscalculation on his part. Here's the problem. With now rolling blackouts in China, forced industries being to shut down completely to try to solve this electricity problem, you don't have the supply chain to basically construct. So not only do you have his common prosperity and three red lines policies, 3 red lines being they put leverage on property developers. If you went over those leverage limits, you couldn't construct. That was another big deal. But now you have, an electricity crisis. So I think all of this is resonating in lowered construction in China, which again is a major part of their GDP, roughly 28% of their GDP. Real estate is 78% of the wealth in China. And these property developers are levered to the gills. And they're defaulting, like I said, across the board.
We're seeing coal prices skyrocketing, and the way that this specific part of the Chinese economy is deeply intertwined with commodity markets around the globe. Coal prices are spiking. What you're talking about should lead to, decline in demand for iron ore, decline in demand for copper, aluminum, but yet you cite some of those statistics about exports still being up. So when you're thinking about opportunities in the market, it's looking for the places where this is not yet being priced in, where it's being looked through. And I think that that's where I want to take this, and we can start to look at commodities. And then if there are any other areas of the market that you think are, deeply intertwined with these dynamics that you're talking about, but also it's not quite showing up in the data yet, and that's why you guys think there's opportunity there, I think that's where I want to turn this.
So the question is, what does this all mean, right? What does it all mean? And we want to get into that a little bit. So let's get into it. So keep in mind, as a broad kind of explanation, we think initially this is going to be very inflationary. And then as the results and the dynamics and everything starts to gel together, we think it's going to be very deflationary. Let me explain. So for instance, Xi was trying to reduce, Xi Jinping, the president of China, dictator for life, was trying to reduce coal output. And he was trying to do that for reasons associated with his carbon footprint targets, etc. But what did he do? He did a miscalculation. He shut down too much coal output, and electricity demand came back post-COVID in a big way, right? The Delta variant wasn't as aggressive as everybody thought. So that's what I mean when I say inflationary initially, right? State-managed reduction in coal output. You know, you have China, which produces a lot of the world's coal. All of a sudden, the world is short coal. You need coal to produce energy, turn those turbines, energy prices skyrocket. That's what happened, right? And you're seeing that across a number of other industries. They did the same thing. Steel output in China is collapsing. The reason, we believe, is two-pronged. Number one, because of state-determined reduction in steel output, again, to meet its carbon offsets goals, but also the reduction in construction. You just don't need the steel. So initially, steel prices skyrocket, right? That's what we're seeing now. You're seeing commodity prices skyrocket. However, China has now said, turn back on the spigots, bring in the imports. They're turning back on the coal spigots. They're turning back on the steel spigots. So we think longer term, what's going to happen is China's going to start to produce more coal, produce more steel, but we still believe that Z is going to be very focused on making housing affordable. So we think the main demand driver is going to remain muted. So what does that mean? That means the world's biggest producer of commodities and biggest demand center, China, is going to have a lot more supply, a lot less demand. So we think ultimately what that will resonate in is deflation, lower steel prices, lower coal prices, because China will be producing a lot. And we think it's going to be more pronounced in the steel space because we still think there's going to be electricity demand, but we think you'll have lower coal prices, significantly lower steel prices. And we think, as we've seen with China, they'll export that deflation to the rest of the world. So what happens, right? You look at the steel stocks across the world, they've been on a tear. You look at the coal stocks across the world, they've been on a tear. We think, you look at the iron ore stocks, they've been on a tear, right? Steel consumption, steel demand in China remains weak because they're looking to make property affordable. Keep in mind, think about this, right? 78% of your wealth is tied up in China real estate. Real estate prices start falling. What are you going to do? You're going to go out and buy more real estate? No, you're probably going to sell it. It's probably going to be fire sale. You're a politician. You own 1,000 apartments across China. Are you going to sit there and hold on to those, or are you going to sell them? You're probably going to sell them. As prices fall, demand will get worse. So we think that the biggest hit, probably in our view, is going to be to the iron ore sector. And we have sell ratings of Fortescue and Rio Tinto. We think those stocks are headed significantly lower. The second biggest hit, we believe, will be to steel prices in China, but also Europe. Keep in mind, the U.S. currently has massive tariffs, basically outlaws the shipment of Chinese-made steel into the United States. However, we think the U.S. mills will get hit. Why? Because China will export that steel to Europe. European steelmakers won't be able to sell in Europe, so they'll export that steel into the U.S. Already, we're seeing imports into the U.S. of steel pick up. Those imports are going to hit our shores late November, early December. So we think next year the pressure on U.S. steel prices are going to be significant. We have buy ratings. We like the stocks, U.S. Steel, Cleveland Cliffs. But we think the outlook could dim as we enter next year. So we'll have to look at what's going on there.
Well, that's an interesting dynamic we were talking about with the inflation switching to deflation. So let's focus a little bit on the time frame for this. You gave us the picture on steel as being something that the imports to the US are going to come. We're going to see the downward pressure on US steel prices. But in terms of how long does that usually take to be priced into the stocks before people start to realize that this isn't something that was just an anomalous 1 month of data, but actually a longer term trend, which really needs to be factored into these financial models?
That's a great question. Great question. So every week, the cost curve Bloomberg has, I'm sure other sites have, is updated. And that cost curve has been inverting down. Every week we get updates from CRU and Still Market Update. My buddy there, Mike, is a great analyst on steel, one of the best in the world. We get updates every week. So every week when those prices come out, if they're moving lower, the stocks are going to move lower. Here's the problem, right? Steel prices are sitting at $1,900 per ton. At $1,000 per ton, these guys are minting cash. The problem, though, is you got to wait until they report their quarterly numbers. So if you're telling me U.S. Steel, Cleveland Cliffs, Nucor, STLD, ArcelorMittal, all the steel mills, they're going to blow out numbers in Q4 and Q1. But you're also telling me the price of steel in the U.S. is going to go from 1,900 to 1,000. Guess what's going to happen to those stocks? You're going to have 50 data points in between quarters where prices are falling. So to answer your question, long-winded way of me saying, if prices are coming down, even though it doesn't necessarily make fundamental sense, I think it's going to weigh heavily on the steel stocks. So prices have already started to come down. Prices have peaked. We also get lead times on a bi-weekly basis in the United States, and we get imports every week. The data has already started to turn, right? U.S. Steels went from 30 to 21. Cleveland Cliffs went from 25 to 21. So I think if that data continues to be negative, I think you're going to get pressure in those steel stocks. Again, we're still bullish because we think the earnings numbers are going to be good, but we're monitoring those data points very closely to see if and when is the time to turn.
So do you think this is something that people might be looking for a pop on earnings as potentially a place to start building a position?
Yes, and I also think one of the things we were most excited about is there's no doubt the steel mills are literally minting cash. You can call them the baby Federal Reserves. Maybe not the best analogy, but these guys are minting cash. We're very excited about the prospect of U.S. Steel and Cliffs paying down those big debt loads. The problem is, so far, we're bullish, but they haven't done it, right? So what is U.S. Steel doing? They're building more EAF furnaces. What is Cleveland Cliffs doing? They're buying back the preferred stock from Middle, and they just announced yesterday they brought a scrap player. We'd love to see them use that excess cash to pay down debt for when the rainy times come, which they will. So that's another thing we're focused on.
I want to talk about sequencing of maybe some of these commodity bets. You've got coal that you talked about, iron ore, and then steel. Do you see them as pieces that are part of the same puzzle, but maybe a sequence that you might want to play?
Absolutely. Good question. So keep in mind, you know this, to make steel, you need iron ore, you need coking coal. So they're all interrelated. But, there's also thermal coal, which you use to power electricity. So with respect to steel and iron ore and coking coal, those are all going to be tied closely together. And those markets are driven by far overwhelmingly by construction in China. And you know our view on construction in China. We think it's going to be bad. We think it's going to be bad for a long time. We think Xi's in a position where he has to bring that price to income ratio of 40 times down significantly. London 22, New York 12, affordability defined as 3 times. So he has to bring that down significantly. So we think that's a more secular kind of downdrift. So we think long-term that's going to pressure things. But one other commodity, and I don't know if you want to talk about this, nuclear, right? Nuclear is skyrocketing. You got Sprout out there that's cornered the market. They're doing at-the-market equity issuances, using that money to buy nuclear. We think nuclear is going to be on fire. So one of the beauties of nuclear is, and I want to make sure your viewers understand this. So if you're a nuclear power plant, roughly 1% of your cost, just 1%, is actually uranium fuel. So the point is, nuclear power plants are inelastic to price, meaning prices right now are 40, right? To start this year, they were in the low 20s. Prices could go to 50, 60, they could go to 120. It doesn't matter. These guys are still going to be buying. So when you consider a guy like Sprott is buying the equivalent of like 2 to 3 nuclear plants almost every week, we believe, and when you look at our supply-demand model, you have a roughly 20% deficit. We believe that nuclear prices are about to skyrocket higher. And when you consider, right, what's going on, right? California, ton of solar, ton of wind. Texas, ton of solar, ton of wind. Germany, ton of solar, ton of wind. What's happening there? Rolling blackouts, energy shortages, right? In Europe, people are looking at basically literally people freezing to death because the lack of electricity. What's happened in Europe? They've shut down coal, they've shut down nuclear, distributed baseload power. They've replaced it with solar and wind, unreliable intermittent peak load power. It's just, for lack of a better word, dumb policy. The West is pursuing dumb policy. China and India are laughing. They're ramping coal, they're ramping nuclear. So what happened yesterday? In about face, France came out and said, you know what? Not only are we not going to decommission our nuclear plants, we're going to build 6 more. Finland came out and said something similar. I think as people start to freeze to death this winter due to poor policy in the West, poor energy policy, shutting down distributed baseload power, oil, natural gas, nuclear, replacing it with unreliable intermittent peak load, wind and solar power, panels made in China, slave labor. I think as people start to, basically suffer the consequences of this virtue signaled energy policy, I think there's going to be about shifts across the spectrum in Europe. And as that happens, the word nuclear is no longer going to be a bad word. It's no longer going to be a nasty word. It's going to be a word associated with ESG, associated with clean energy. And it is. Nuclear is the cleanest form of distributed baseload power, zero emission, the safest form of energy, nuclear. Guess how many people died at 3 Mile Island? Zero. So the point is, I think that there's going to be a resurgence in sentiment around nuclear. You saw some of that in the stocks yesterday. We initiated Camco around $26 price target, took our target to 36. I think the stock's around high 20s right now.
25 about.
Yeah, we think it's going to surpass our price target. Look, I think that nuclear is the next bubble sector, the next EV sector. Rightfully so. We think rightfully so. So I just wanted to talk about that as a commodity because we want to highlight we're not all negative. There's some stuff we like out there.
Well, Gordon, thank you for bringing your set of fresh eyes to these issues. I look forward to having you back on soon so we can discuss this again.
Hey, thanks for having me. I appreciate it.